The math no longer makes sense. We are currently staring down $36 trillion of national debt. Oil has just breached $100 a barrel, and the global economy is screaming stagflation. Yet, the S500 just touched 7,100 points. It is the most expensive market in human history, defying every traditional metric of valuation and leaving every rational investor asking the same desperate question: why hasn't it crashed yet? Most people are looking at the headlines, waiting for a black swan event that has already arrived, but they're blind to the four invisible structural forces that have decoupled the stock market from reality. We are currently trapped inside a passive money machine that buys regardless of price, protected by a Federal Reserve put that has been forced into its most dangerous evolution yet. If you are managing a 401k, a Roth IRA, or an ISA, you are likely being told to just keep buying. But with a CAPE ratio sitting at a staggering 41, you aren't just investing, you are participating in a high-stakes algorithmic experiment where the exit doors are narrowing every single day. The AI revolution is no longer a growth story. It's been priced for absolute perfection, leaving zero margin for error in a world where bond yields are threatening to trigger a systemic liquidation. In this breakdown, we are going beyond the doom and gloom noise to expose the algorithm engine and the options market mechanism that are artificially inflating your portfolio values while the underlying foundation of the financial system erodes. There are four specific kill switches indicators hidden deep within the credit markets and liquidity cycles that will signal exactly when these invisible forces will finally fail. If you don't know what they are, you aren't an investor. You're a passenger on a plane with no landing gear. By the end of this video, you will understand the terrifying logic behind this record-breaking market and the exact mental framework you need to navigate the most confusing year in recent memory. We are revealing the strategy to diversify your exposure before the four forces stop holding the line and the passive bubble finally pops. Stay until the end, because the rules of the game have changed, and the old playbooks are about to become very expensive mistakes. To understand why your portfolio looks like a gold mine while the gas pump looks like a crime scene, we have to look at the cold, hard math of the $36 trillion debt mountain. For decades, the relationship between the economy and the stock market was like a dog on a leash. The dog might run ahead or lag behind, but eventually, the leash of economic reality pulls it back. Today, that leash hasn't just been stretched, it's been severed. Right now, the United States is paying over $1 trillion a year just in interest on that debt. That is more than the entire defense budget. In any other era of human history, this level of fiscal recklessness would have sent bond yields screaming toward double digits and the stock market into a tailspin. Yet, here we are with the S500 at 7,100. The reason this hasn't triggered a collapse is that we have entered the era of liquidity-driven delusion. The financial system has become a closed loop where the debt is so massive that the Federal Reserve and the Treasury have no choice but to ensure the markets stay elevated. If the market crashes, the tax receipts vanish, the collateral for the debt disappears, and the entire house of cards falls. This is the ultimate too big to fail scenario. But it's no longer just about the banks, it's about the entire valuation of the Western world. For the average investor in the US or the UK, this creates a terrifying cognitive dissonance. You see $100 a barrel oil, which historically acts as a massive tax on the consumer and a precursor to every major recession since 1970. You see your grocery bills doubling. You see the stagflation monster where growth stalls but prices keep climbing, peering over the horizon. And yet, every time you log into your Vanguard or Fidelity account, your balance is up. You've been conditioned to believe that time in the market beats timing the market. And for the last 15 years, that mantra has been gospel. But the CAPE ratio, the cyclically adjusted price-to-earnings ratio, is currently sitting at 41. To put that in perspective, It was 30 before the 1929 crash and 44 at the peak of the dot-com bubble. We are breathing the thin air of a financial Everest, and most people are climbing without oxygen masks. This brings us to the first of our invisible forces, the passive money machine. We have reached a critical tipping point where more than 50% of the U.S. equity market is now managed passively. This is a structural shift that has fundamentally broken the price discovery mechanism of the market. Think about how a 401k or an ISA works. Every 2 weeks or every month, millions of people have a portion of their paycheck automatically deducted and sent into the market. These algorithms don't care if the S500 is at 3,000 or 7,000. They don't look at PE ratios, they don't look at the $36 trillion debt, and they don't care about $100 oil. They are programmed to do one thing: buy. This creates a self-fulfilling prophecy. Because the largest companies in the index, the Magnificent Seven and their AI-adjacent successors, get the lion's share of every dollar that enters an index fund, their prices go up. As their prices go up, their weight in the index increases, meaning the next dollar that enters the market buys even more of them. It is a feedback loop of historic proportions. We are essentially living in a valuation-less market, where price is determined by flows, not fundamentals. If you are holding an index fund right now, you aren't investing in the genius of American or British industry. You are riding a momentum wave, fueled by automated payroll contributions. But what happens when the flow stops? Or worse, what happens when it reverses? In a traditional market, when a stock gets too expensive, value investors sell and wait for a better price. In a passive-dominated market, there is no value floor. If a recession finally hits hard enough that people stop contributing to their 401ks or worse, they start withdrawing to pay for that $100 a barrel oil and inflated groceries. The machine starts selling with the same mindless aggression it used to buy. Because there are so few active managers left to provide a bid based on fundamentals, the exit doors become incredibly narrow. And then there is the AI revolution. In 2023 and 2024, it was a story of hope. In 2026, it has become a story of necessity. The market has priced in a scenario where AI doesn't just improve productivity, it has to save the entire global economy from the weight of its own debt. Every major tech giant is currently being valued as if it will achieve a level of profitability that has never existed in the history of capitalism. We are looking at perfection pricing. If Nvidia, Microsoft, or Apple miss their growth targets by even 0.5%, or if the massive capital expenditure on AI data centers doesn't show an immediate, massive ROI, the algorithm engine will pivot from accumulate to liquidate in a matter of milliseconds. You've likely been told that the Fed put is your ultimate insurance policy, that Jerome Powell and the Federal Reserve will always step in to lower rates or print money the moment the S500 drops by. 10%. And for a decade, that was true. But in a $100 oil, high-inflation environment, the Fed is trapped. If they print money to save the stock market, they explode inflation and destroy the dollar. If they fight inflation by keeping rates high, they bankrupt the Treasury and crush the stock market. They are being forced to choose between the value of your portfolio and the survival of the currency itself. But here is the unsettling truth that nobody in the mainstream media is willing to admit. The stock market isn't hitting record highs because the economy is strong. It's hitting record highs because the currency is dying. When you see the S500 at 7,100, you aren't seeing an increase in the value of corporations. You are seeing a massive, desperate flight out of a debased currency and into the only assets that the passive money machine is allowed to buy. The market isn't a bubble in the way we understood it. In 2000 or 2008, it's a barometer of how much faith has been lost in the dollar. And that changes the entire strategy of how you protect yourself. We aren't waiting for a crash anymore. We are waiting for a transition to a system where the old rules of diversification actually become your greatest weakness. To understand why the S500 is behaving like a vertical line on a chart, you have to understand that we aren't trading in a market anymore. We are trading in a giant, pressurized tank of weaponized volatility. This brings us to the second invisible force, the options market mechanism. In 2026, 0DTE 0 days to expiration options have gone from a niche tool for gamblers to the primary engine driving daily price action. Nearly 60% of all trading volume on the S500 is now concentrated in contracts that expire in less than 24 hours. This has created what professionals call the gamma trap. When you buy a call option, the market maker who sold it to you has to stay delta neutral. If the market ticks up, they are forced to buy the underlying stock to hedge their position. Because millions of retail traders and algorithmic bots are piling into these short-term bets every single day, the market makers are forced to buy billions of dollars of stock just to keep their books balanced. This is why you see the market grind higher on no news. It's a mechanical squeeze. It feels like a solid floor, but it's actually a feedback loop built on a foundation of sand. The market is no longer a reflection of corporate value. It's a reflection of the hedging requirements of Wall Street's biggest desks. But here is the catch. What works on the way up works with double the violence on the way down. The moment the buying pressure stalls, those same market makers have to dump their hedges instantly. The floor doesn't just crack, it vanishes. And that brings us to the third force, the algorithm engine. We are no longer trading against humans. You are trading against neural networks systems like BlackRock's Aladdin that process sentiment, bond yields, and social media trends in nanoseconds. These algorithms have spent the last decade learning one specific pattern: buy the dip. They have been trained in a low inflation, low-rate environment where the Federal Reserve always had their back. But in 2026, the inputs have changed. The algorithm engine is currently front-running the passive money machine we talked about earlier. These bots know exactly when your 401k or ISA contributions hit the market. They buy 30 seconds before the passive funds do, driving the price up, and then sell that liquidity back to you at a premium. It's a closed-circuit extraction of wealth. They've turned the slow and steady investor into the exit liquidity for high-frequency code. You've been told that the AI revolution is the reason for these gains, but the data tells a different story. We are seeing a concentration risk that would make the 1999.com era look diversified. 10 companies now represent more than 35% of the entire S500. This isn't a broad-based bull market, it's a narrow skyscraper built on 10 pillars. If one pillar cracks, the whole roof caves in. And that crack is already starting to appear in the AI ROI gap. Companies are spending hundreds of billions on H100 chips and data centers, but the productivity gains are lagging. The market has priced in a miracle. It has priced in a world where AI solves the $36 trillion debt crisis by generating trillions in new tax revenue. If that revenue doesn't materialize in the next 2 quarters, the algorithm engine won't just trim its positions. It will execute a systemic liquidation faster than you can log into your brokerage account. So, how do you know when the algorithm engine is about to flip the switch? This is where we get into the 4 kill switches, the deep market indicators that tell us the invisible forces are losing their grip. Kill switch number 1, the 10-year Treasury yield. For years, the magic number was 4%. In 2026, with $36 trillion in debt, the new danger zone is 5.5%. When the yield on the 10-year Treasury crosses this line, the math for the U.S. government becomes terminal. At 5.5%, interest payments alone begin to consume 40% of all federal tax revenue. This is the point where the bond vigilantes return. They realize the government can never pay the money back in real terms, and they start dumping debt. When the bond market breaks, the stock market follows within days. Kill switch number 2, the credit spread blowout. Watch the high yield or junk bond market. Right now, the passive machine is keeping these spreads artificially tight. Investors are so desperate for yield that they are lending money to failing companies for almost the same price they lend to the government. But keep a close eye on the TED spread, the difference between the interest rate on interbank loans and short-term government debt. The moment this spikes, it means the banks have stopped trusting each other. It's the sound of the pipes freezing. Kill switch number 3. The yen carry trade collapse. This is the hidden liquidity source of the global elite. For decades, investors have borrowed money in Japan at 0% interest to buy high-yielding U.S. tech stocks. It's been free money. But the Bank of Japan is finally being forced to raise rates to save the yen. If the yen strengthens too quickly, the carry trade unwinds. Billions of dollars of leveraged positions in Nvidia, Microsoft, and Apple will be sold simultaneously to cover Japanese loans. It's a margin call on a global scale. Kill switch number 4, the reflation pivot. This is the most dangerous one for your 401k. Historically, when the market crashes, the Fed cuts rates and your bonds go up in value, offsetting your stock losses. That's the 60/40 portfolio rule. But in a stagflationary world where oil is at $100, the Fed can't cut rates without sending gas prices to $15 a gallon. If the market crashes and the Fed is forced to raise rates or stay flat to save the currency, the 60/40 portfolio fails. Both your stocks and your bonds lose value at the same time. There is nowhere to hide. The mainstream media is telling you that the soft landing has been achieved. They want you to believe that the $36 trillion debt mountain is just a number that doesn't matter. But the passive money machine is running out of fuel. The options mechanism is becoming too volatile to manage, and the algorithm engine is looking for the exit. We are moving from an era of value creation to an era of liquidity survival. The S500 at 7,100 isn't a sign of health, it's a sign of a fever. The currency is being devalued so quickly that the nominal price of stocks has to go up just to keep pace with the falling purchasing power of your dollars. You aren't getting richer, you are just losing ground more slowly than the person holding cash. But there is a specific mental framework you can use to stay ahead of this. You need to stop looking at price and start looking at liquidity cycles. You need to understand the difference between an asset and a liability in a world where the old playbooks are being burned. Because when these 4 kill switches are triggered, the exit door will be no wider than a needle's eye, and the passive machine will be the first thing to get crushed in the doorway. The question isn't whether the market will crash, it's what will be left of the financial system when the liquidity-driven delusion finally meets the wall of $36 trillion in reality. To survive what's coming, you have to realize that the rules of diversification have changed, and the most dangerous thing you can do is nothing. So, if the most dangerous thing you can do is nothing, what is the most intelligent thing you can do? To solve the riddle of the S500 at 7,100, you must first accept the hardest truth of 2026. The market, as you were taught it in school, is dead. It has been replaced by a liquidity funnel. The answer to the question, why hasn't it crashed yet, is not that the economy is resilient, it's that we are witnessing the great nominal illusion. In a world of $36 trillion of debt and $100 a barrel oil, the price of stocks is no longer a signal of corporate health, it is a desperate signal of currency debasement. The market isn't rising, the floor is sinking. When you understand this, you stop looking for a crash in nominal terms and start looking for the evaporation of real value. The mental framework you need to survive this transition is built on 3 pillars: anti-fragility, liquidity awareness, and the pivot to tangibility. First, you must dismantle the passive money machine in your own head. For 30 years, the index and chill strategy was a shortcut to wealth. In 2026, it has become a strategy of collective suicide. Because the index is so concentrated in the Magnificent Seven and their AI-bloated successors, being diversified in an S500 fund is actually the most concentrated bet in financial history. To protect yourself, you must move toward a barbell strategy. On one side, you hold extreme liquidity, cash equivalents, and short-term T-bills that allow you to act when the kill switches flip. On the other side, you hold hard assets, companies with high pricing power, real-world infrastructure, and commodities like oil and gold that thrive in a stagflationary environment. You are seeking to own things that the algorithm engine cannot print and the passive machine cannot dilute. Second, you must front-run the reflation pivot. When kill switch number 4 is triggered, the old 60/40 portfolio will become a double-edged sword that cuts you twice. To counter this, you must look at uncorrelated assets. This is why we are seeing the massive institutional shift into private credit, high-yield infrastructure, and scarce digital assets. These are the lifeboats being lowered while the algorithm engine is still playing music on the S500 deck. You need to be positioned in assets that don't rely on the Fed put to exist. Third, you must recognize that the AI revolution is real, but the AI valuation is a hallucination. The productivity gains from AI will eventually save the economy, but not before the current perfection pricing is purged. The strategy here is value over hype. You don't buy the company selling the dream of 2030, you buy the companies providing the energy, the cooling, and the physical land that the AI revolution requires to breathe. In a $100 oil world, the physical constraints of the real world are the only things that matter. You are trading the digital mirage for the physical foundation. This brings us to the core realization, the one that the mainstream media is terrified to mention. We are currently in the middle of a silent monetary reset. The reason your portfolio looks like a gold mine while your life feels more expensive is that the financial system is sacrificing the currency to save the process. Collateral. They are choosing to keep the S500 at 7,000. 100, even if it means a gallon of milk, costs $10. They would rather you have $1 million that buys nothing than $100,000 that buys a house. The kill switches we discussed aren't just warnings. They are the transition points into this new reality. When the 10-year Treasury yield crosses 5.5%, it isn't just a market event. It is the moment the government loses control of the narrative. When the yen carry trade collapses, it is the moment the global free money era finally ends. Your job as an investor is no longer to beat the market. Your job is to exit the system before the exit becomes a stampede. You have been told that you are a passenger on a plane with no landing gear, but that's only true if you stay in your seat. The passive money machine, the options trap, and the algorithm engine are all designed to keep you strapped in while the professionals move to the back of the plane and put on their parachutes. By diversifying out of the automated index trap, by watching the 10-year yield like a hawk, and by prioritizing real value over nominal price, you are putting on your own parachute. The most confusing year in recent memory is actually the most clarifying if you have the right lens. We are moving from a world of financial engineering back to a world of economic reality. The math of $36 trillion of debt is finally catching up to the myth of infinite growth. The S500 at 7,100 is the final, brilliant flare of an old system before it reinvents itself. You now understand the terrifying logic behind this record-breaking market. You know that the Fed put is failing, that the passive bubble is stretching to its breaking point, and that the algorithms are looking for the door. You are no longer blind to the invisible forces. You see the kill switches. You have the framework. In this era of liquidity-driven delusion, the greatest asset you own isn't your brokerage balance, it's your ability to see the board for what it actually is. The rules of the game have changed. The old playbooks are now liabilities. The algorithm engine may control the price today, but reality will control the value tomorrow. You are no longer a passenger. You are an architect of your own survival in the age of the $36 trillion debt mountain. You have been warned. You have been educated. And now, you are ready to navigate the most significant financial transition of our lifetime. The blueprint for survival in this $36 trillion reality isn't a static document. It's a living, breathing strategy that requires constant calibration as these 4 kill switches begin to trigger. You've seen how the passive money machine and the algorithm engine have weaponized the index against the average person. You now realize that the mainstream financial press will be the last to tell you when the liquidity floor finally evaporates, simply because their entire business model depends on you remaining strapped into your seat until the moment of impact. But your position has fundamentally changed. By understanding the mechanics of the great nominal illusion, you've graduated from being a passive passenger to becoming a strategic navigator. The challenge you face now is staying synchronized with a market that moves at the speed of light and reacts to inputs that the human eye can no longer see. We built this platform specifically for those who refuse to be the exit liquidity for the high-frequency code and the institutional desks. Our mission is to provide the raw, unfiltered intelligence on liquidity cycles, credit spreads, and the pivot to tangibility that you won't find in a standard brokerage report or a Sunday morning talk show. We are tracking the 1-0-year yield, the Japanese monetary policy, and the physical constraints of the AI revolution every single day, because in a world of weaponized volatility, information isn't just power. It is the difference between preserving your family's legacy and watching it dissolve in a debased currency. If you recognize that the old diversification playbooks are now your greatest liabilities, and you are committed to building an anti-fragile portfolio that thrives on the very chaos that will crush the passive crowd, then you have found your tribe. This is where we monitor the kill switches and decode the transition from financial engineering back to economic reality. To ensure you have the updated coordinates as the 1-0-year Treasury yield approaches that terminal 5.5% mark, and to be part of a community that prioritizes real value over the digital mirage, join us by hitting subscribe. By doing so, you aren't just following a channel. You are securing your seat at the table where the new rules of the game are being mapped out. The exit doors are narrowing every single day, but for those with the right lens, the path to survival is visible. Let's build your landing gear together. Stay sharp, stay liquid, and we will see you inside the next update.